Welcome to an introduction to managerial accounting, brought to you by Parkbench Tutors and narrated by David Hopcroft. For more information about Parkbench Tutors, please visit parkbenchtutors.com. In this podcast, we shall look at how changes in units of production and unit sales will affect the income statements and the inventory value when the two different methods are used. In the first situation, which we examined in detail in podcast 1, we assumed production and sales were equal. We determined that net income was the same for each method. The key to these calculations is the use of unit cost under full costing. This is determined by adding the variable production cost to the fixed production cost and then dividing the result by the number of units produced. We started with 1,000 units being produced and 1,000 units being sold. We had figures for sales, for direct material, direct labour, variable overhead and variable selling costs. We also had figures for fixed manufacturing overhead, fixed selling expenses and fixed administrative cost. Our unit cost under full costing will be to take all the variable costs for material, labour and overhead and multiply these by the number of units produced. Then we add the fixed overhead. Finally, divide this total by units produced. So when 1,000 units are produced, the unit cost under full costing is $2,190. Let us prepare our full costing statement. Sales of 1,000 units give sales of $4,500,000. To determine the cost of goods sold, we take the figure that we had for our unit costs, $2,190, and multiply by the 1,000 units sold to get a value of $2,190,000. We calculate gross margin by subtracting cost of goods sold from sales. The selling expense is determined by adding the fixed selling expense to the total of the variable selling expenses. Fixed selling expense is $60,000 and variable selling expense is $25 multiplied by 1,000 units to give $25,000. So the total expense is $85,000. We add the administrative expense, then we take these expenses from gross margin, and we have a net income of $2,130,000. To determine the income statement for variable costing, we put in the sales figure, then we determine the variable cost of the goods sold. The variable cost is the sum of direct material, direct labour and variable overhead multiplied by the number of units sold. This gives us a total of $2,040,000. We now enter the variable selling costs, which are $25 multiplied by 1,000 units, giving $25,000. Subtracting the variable costs from sales, we have a contribution margin of $2,435,000. Now we enter the fixed costs for manufacturing overhead, selling expense and administrative cost. Subtracting these from the contribution margin, we have a net income of $2,130,000, as before. The value of items in inventory is determined by the number of items. If all items produced are then sold, then there is no value in inventory. The method of determining the value for full costing is to take unit costs for direct materials, direct labour, variable overhead, and then fixed manufacturing overhead per unit. Add these together and then multiply by the number of units in inventory to get the value. Obviously, with no items in inventory, the value is $0. To determine the value where variable costing is being used, we take the unit costs for direct materials, direct labour and variable overhead. We add these and multiply by the number of units in inventory to obtain a total value. Based on the results for the first year, the company decides to double production to 2,000 units for the next year. However, at the end of the year, only 1,500 units have been sold. How do these results affect income statements produced under full costing and variable costing? and how do they affect inventory values. When production exceeds sales, first, we determine the unit cost under full costing. Remember that this time we have 2,000 units produced. The cost per unit falls now to $2,115 per unit produced. Remember, the fixed costs are now being shared among a greater number of units, which is why the unit cost is falling slightly. The cost of goods sold will be the unit cost for full costing multiplied by actual sales. This gives 2,115 multiplied by the 1,500 units sold. This is a total of $3,172,500 for cost of goods sold. We now enter selling expenses and administrative expenses. The full costing income statement now gives a net income of $3,385,000. For the variable costing statement, we require the variable cost of goods sold. This will be the sum of direct materials, direct labour and variable overhead per unit, multiplied by the number of units sold. So, 1,200 plus 800 plus 40, which is $2,040, times 1,500, which equals $3,060,000. We determine the variable selling costs, subtract these and cost of goods sold from the sales to give a contribution margin of $3,625,500. From this, we subtract our fixed costs from manufacturing overhead, selling expense and administrative cost. This gives a figure of $3,347,500 for net income. There is a difference in net income between the two methods. The difference is $37,500. Variable costing shows a lower income than full costing. Why is this? Remember that variable costing expenses manufacturing overhead in the period in which it occurs. This lower figure for income must be reflected elsewhere. We now look at inventory value, which will form a part of the balance sheet. For full costing, the figures are shown here. The number of units in inventory will be 500. We obtained this figure because although 2,000 units are produced, only 1,500 are sold. The balance of 500 units remains as inventory. Completing our entries, our calculation finishes with an inventory value of $1,057,500. When we do the calculation for variable costing, we have a figure of $1,020,000 as the value for inventory. We can see that the full costing gives a higher income of $37,500, and this figure equals the higher inventory value under this method. Remember that the lower figures for variable costing result from a part of the overhead being expensed in the period in which it occurs. What happens in the opposite situation? Suppose, as an example, our company produces 2,000 units but is able to sell 3,000 units. Of course, there must have been an extra 1,000 units in inventory at the start of the year for this to happen. Let us see how this affects income statements and inventory values using full costing and variable costing. Here is a reminder of the information needed to make the calculations. Note that we have 2,000 units produced and 3,000 units sold. With full costing, the net income is $6,925,000. With variable costing, the net income is $7 million. There must be 1,000 fewer units left in inventory, and we shall focus on how this alters value of inventory. Under full costing, the inventory value has fallen by $2,115,000. Under variable costing, the inventory value has fallen by $2,040,000. The difference in net income between the two is $75,000. Note that variable costing gives the higher income if sales exceed production. This is the same difference as the inventory valuation difference. The lower income from full costing is also reflected by the lower figure for inventory value. This ends our second podcast on full and variable costing, brought to you by Parkbench Tutors and narrated by David Hopcroft. Thank you for watching and for listening. We wish you success in your studies. For more information about Parkbench Tutors, please visit parkbenchtutors.com.